South Africans obviously will be hoping for an early Christmas gift this afternoon in the form of an interest rate cut. We've got Devan Murugan from the ENCA Money Desk to give us the latest. And Devan, the million-dollar question is, can we expect a rate cut?
Yeah, well, in short, no, if you go by the large contingent of analysts that believe that it won't really happen. But of course, the key question to ask is whether or not we have those factors in place for the MPC to actually say possibly there could be one. Now, it's not just consumers who are rooting for one. Some analysts believe the bank should cut interest rates this afternoon. And here's what the rates look like at the moment. So, 2 meetings ago, back in July, the MPC cut interest rates by 25 basis points. What did it do? It left the repo rate, that's the rate at which the Reserve Bank lends other commercial banks money, at 6.5%. It left your prime rate, that's the lending rate at banks, at 10%. That's where the prime rate sits at the moment. Now, low inflation supports the case for the Reserve Bank to cut rates. And yesterday, we had the lowest print in almost 9 years of inflation, 3.7% for consumer inflation. As I said, that's the lowest since 2011. So why not bring some relief to consumers and cut rates? It will certainly stimulate the economy. But remember, the Reserve Bank watches to see if there are any threats to inflation going forward. Because interest rate adjustments are just one tool used to ensure that inflation doesn't get out of hand. So what will they be considering? Well, possible ratings downgrades by both S&P and Moody's. That might affect the rand and threaten inflation. There's also the US-China trade war. These are all inflation risks going forward, and it's one of the reasons why, generally speaking, a majority of economists feel it might hold steady on interest rates. Here's economist Harvey on what he thinks.
Lower interest rates unaccompanied by very clear economic leadership and dedication to structural changes in the economy will probably do relatively little in the long run. However, it does seem to me that the risks of inflation in the near future are minimal, and therefore the bank would be kind of well within its domain anyway, well within its mandate to lower rates. And of course, lowering rates means that there's a little bit of disposable income left, especially for those who are paying bonds or repaying cars. You know, monthly repayments come down, and therefore there's more money available.